been a monumental week, as we all know, here on Wall Street. The Dow plunging 10%, making it the worst market day since the 1987 market crash. Joining us right now on the Squawk Newsline is Cathie Wood, founder and CEO of ARK Invest. Good morning to you, Cathie. Nice to have you on the program. We've spoken so many times over the past several years, and this pandemic was something that was not on any radar when taking into some calculations the future price of Tesla and so many of the other stocks that you own. What have you been thinking and doing this week?
Thank you, Andrew. However much we hate these kinds of time periods, very difficult for everyone, we do know, our focus being only on disruptive innovation, that innovation gains much more traction during difficult times than it does during normal times. So while our stocks, especially in the last 3 days, have taken it on the chin with the market, we know that our companies are gaining market share. This happens in every crisis. It happened in 08, 09, and so we are leaning into innovation and concentrating our portfolio to either the names that have been beaten up relative to others or our highest conviction names.
So you've been buying more. Is there anything you've sold?
Yeah, we have sold. Actually, we've sold stocks that held up pretty well during the downturn until very recently, like Teladoc, Inovio, which is a vaccine company associated with the coronavirus. We've sold a little Netflix, which really held in beautifully, but not because our conviction in these names has gone down, but because other names were being trounced and we were seeing amazing opportunities.
You know, we've talked about oil prices for so long, and we've talked about Tesla and the impact of low oil prices on the movement towards electric vehicles. Is your thinking changed at all?
No. The reason for that is even at these lower oil prices, we've done the calculation, the total cost of, meaning if they translate it into gasoline, the total cost of ownership of an electric vehicle compared to a like-for-like gas-powered vehicle is still lower. And you know what? Electric vehicles are better cars at the end of the day, and I think anyone who has driven in a Tesla can attest to that.
Can you just walk us through the like-for-like math? Meaning, what does a barrel of WTI crude have to cost where an electric vehicle... And by the way, let's talk about a Tesla vehicle. Are we talking about Tesla vehicles? Or
well,
are we talking
it's like for like. It's like for like. So the total. What's happening here is battery costs are declining. For every doubling in electric vehicle sales, the number of units produced, battery costs are coming down roughly 18%, and this has happened for. It's happened for the last 10 years, especially with Tesla pushing the envelope. So those battery prices have been coming down steadily. This sharp decline in oil prices, first of all, it may not last. Especially now that the oil producers are cutting capital spending plans so aggressively. But even at this price, it's really the battery cost that has pulled the total cost of ownership down, and will continue to.
Well, maybe if clean hydrocarbons are powering the grid, then those would go down in price too, and maybe electricity's even. I don't know.
No, you're right.
I'm trying to help.
Mike, I don't know if you're still there. When you jump into this conversation, you've been talking to a lot of traders and investors over the past week in terms of some of these names that Cathie historically has been in, and also this issue of where oil stands right now.
Yeah, what's interesting is that going into this, and when the market was at its highs, you would have been able to look at those select group of huge growth tech companies and say, wow, they look like they're dominating the market. They're perhaps overrepresented in the indexes, and maybe that's where the excess of this market is. Guess what? They've actually not underperformed really as a group on the way down, if you look at things like the Nasdaq 100. So this suggests this sell-off hasn't so much been about, oh, we had a little bit of froth in some parts of the market, and we're taking it out right now. It is really an economic shock, the sudden stop that's going on, and then turning into energy on top of it the oil crash, and what it means for credit. So now the market is, for the last few days, been really hunting those companies that have a big debt overhang that maybe aren't going to be able to handle a few months of reduced or zero sales. So that's changed the story a little bit. It hasn't necessarily altered the broader picture where, hey, secular growth seems like it still has a bid here. Obviously, some of the real story stocks, Virgin Galactic got taken apart because it really did end up being a little bit of a cult situation. But in a broader sense, the established ones, it hasn't been about that. It's been mostly about, look, let's run this whatever length of time the economy is going to stall out in a sudden way, run it through everybody's numbers, and that hits the more economically sensitive areas and the banks more than it does other types of companies.
Right. Cathie, in terms of, and I hate to keep going back to Tesla, but it's a company that we've talked so much about together over these years. When you look at demand for these vehicles over the next, I'm trying to even understand how you do the math. Do you say to yourself, there's almost zero demand for the next 2 months, 3 months, and then it gets pulled forward later or gets pulled backwards? How do you even do it?
Yeah, actually, we believe, sure, of course, sales are going to be hit hard here. I think the consumer is in a bit of shock, but the consumer saving rate is pretty high. So we know that a lot of people have been ordering Teslas. We think that Tesla's share as a percent of all electric vehicles and as a percent of all auto sales is actually going to go up because it is the secular grower within the auto industry. Electric is, we believe, and Tesla is leading the charge.